In this short Bennett Explains finance video, I want to answer a simple question. Should you copy company directors when they buy and sell shares? Right, let's have a look. The logic is very straightforward. Basically, if the insiders, the people who actually run a company, the people closest to what's going on inside the company, are buying or selling shares, there is a school of thought that says, surely investors should jump on the bandwagon and tuck themselves in as quickly as possible behind the directors, buy when they buy, sell when they sell. Because surely they are the people who know the most about what the company's up to and are surely most likely to get their timing right. I'm afraid, as a theory, it sounds beautifully simple. Buy when they buy, sell when they sell, it's public information. What could be easier? That's it. Unfortunately, the reality is you need to look closely at why directors are buying and why they're selling before you jump to any conclusion. Let me explain what I mean. So, drilling into purchases. Let's look at purchases, and studies have shown that if you're going to follow this technique at all, it works better for purchases than for sales, for reasons that will become apparent in just a moment. Reasons when I would get interested in directors buying, and you have to do a bit of homework to unearth these, or get someone to do the homework for you, they appear to be confident in a firm's future prospects. So there's a good reason for them to pile into stocks, because there are bad reasons or not so convincing reasons too. Number two, they are genuinely committed to the firm. Now, it helps if they are someone important who's been around a while. And I stress the second part of that sentence. So the FD, they're usually pretty close to the numbers, pretty close to the coalface, finance director, the CEO, the non-executive chairman, not any non-executive director, because some of them only come in once a month, if that, but maybe the person who's at the head of that committee. Yes, so important people who've been around a while, that adds weight to the argument, maybe you should follow them. And or they work for small and mid-cap firms. Again, papers have been published that demonstrate that if you're going to follow the directors, it tends to work better, on average, if you follow them when the directors are small mid-cap firms. And that's because their influence over the firm and their personal stake in relation to the total share capital market cap could be quite significant. Now, reasons to be wary, reasons why I wouldn't just automatically follow them in. They have to buy. So it's in their employment contract. They've got to show willing. They've got to buy shares. Well, that's just them buying because they've got to, and they've presumably got to do it within a reasonable time of them joining. Not necessarily a reason for you to pile in after them. They're new and they don't have to buy, but they feel like they should to show willing. Again, some of this stuff you need to do a bit of homework on, but it's worth knowing why they're buying. They want to allay fears or create media interest. Because directors' deals are published, it's one way to create a bit of interest in the firm if things are a little bit quiet, and to try and allay fears. There have been classic cases of directors buying right ahead of a firm failing. What are they up to? Are they mad? No, they're just trying to will the market to sort of keep the firm going, if you like. They're part-time, mention that. Non-exec directors, they might buy a few shares as part of a wider holding, but how much time do they really spend doing their homework? And or they're exercising options. Sometimes directors get the right to buy shares because their remuneration package comes with share options, and the reason they're buying is because the price they can buy at using the options is a massive discount to the market price. So they can get a discount that you can't. So you can see, you've got to do your homework, understand why they're buying, don't necessarily think, oh, just follow them anyway. Now, key tests therefore. How many shares are they buying? Is this a small transaction or a large one? Is it one-off or part of a pattern of regular buying? I'm more convinced whether it's a pattern than just a one-off purchase, which you can't really get necessarily all the information about that you want. And what's their total holding and what percentages still represent? So do they already own shares? And how big is the latest deal? If it's substantial, maybe it's worth digging into. If it's tiny, it's not going to tell you a lot, frankly. Drilling into sales then. Now, studies have shown that sales are less reliable indicators, and I'll try and mention why. Reasons why you might be persuaded by a director selling. They have genuine concerns about the future of the firm and they're prepared to discuss those with shareholders, and you buy the story. They've found a more profitable use for their money. Well, if they can find a more profitable use for their money, probably you can too. And or key directors, finance director, CEO, non-executive chairman, are selling simultaneously and selling reasonably large chunks in relation to their previous holding, or bailing out altogether. Sure, but watch out. Partial sales in particular, watch out for, but watch out for any of these. They might just be diluting a large founding or venture capital stake. So they've got to get out at some point, and they're just choosing now to do so. It can be indicative, or it might not be. They need to sell the money to pay for something. Maybe they've got personal reasons to sell that have nothing to do with you. A personal tax bill, for example, school fees, or I don't know, buying that yacht they want, for all I know. They're making up for a shortfall elsewhere. And that's a little bit more indicative. So sometimes in banks, you see directors selling where the bonus has been a disappointment. So maybe that does indicate an underlying business problem. And or they're just minimising a tax bill. All right, so they're doing a little bit of clever capital gains tax work for their own personal tax reasons. All right, so those are reasons on the right-hand side why simply following them and dumping stock would be a bit silly, because their reasons and your reasons won't be aligned necessarily. So there you have it in a nutshell. Conclusions then. If you're going to do it, studies suggest buys are more reliable than sells, but I'm basically saying that in both cases you need to dig into the reasons why directors are buying and the reasons why they're selling. It's a little bit dangerous statistically to just follow them blind, if you like. Investing shortcuts are pretty rare, so for me, directors' deals, it's easy information to get hold of, it's publicly available information, can act as an extra tick in the box. I've done my homework, I think I want to buy some shares. Oh look, a senior director happens to have bought recently. Great, I'll take that as a tick. Selling, the same. But personally, I wouldn't just rely on them as the only way of deciding whether you're going to deal in a firm's shares. Any questions as usual? editor@killick.com.